Welcome back to another episode of Chad Trades, where we look at Bitcoin price action in a non-biased way. Let's have a look what's going on today. We start by looking at the Bitcoin price action on the daily chart. As usual, one candle equals 1 day. We can see that Bitcoin forms ranges, tradable ranges, and channels. So a lot of the time you can draw a channel by using this instead of using the trend line. Use the parallel channel, and you'll be able to find that, for example, if we replace this one and do it ourselves, you start seeing candle closes like this. You drag it down, and then you can expect something of similar fashion, right? Most people dislike channels because they are open to bias. As you can see, the one that was initially drawn was different to the one that we just drew then. So as channels progress, you can change them, right? You change them to start matching the bottom of the candles, bottom of the candle closes. A lot of people use wicks. Wicks are a lot more erratic, sporadic, and change depending on the exchange that you're using. But what we're looking at today mostly is this range. So a good rule of thumb to use within ranges is that the range is just expected to continue until it's broken, same as channel. So why would you bet that it's going to break every single time when, as for example, you can see here something like this range, 1, 2, 3, 4, 5, 6, 7, 8 out of it, 1, 2, you can see what I mean, right? Once a range is established, there's a lot of bounces within the range before the range actually ends up breaking. So that same can be expected within the range that we're in right now. But one thing that I would like to point out is the consecutive red candles that we're starting to get on the daily. So 1, 2, 3, 4, and looking to make a potential 5th red candle. So although we are on the bottom of this range, it starts becoming more high risk when you start seeing candles lining up consecutively. 2, 3, 4, 5, 6, 7, 8. Yeah, 8. So 1, 2, 3, 4, 5. 1, 2, 3, 4, 5. When they start linking, when red candles start linking consecutively, then yes, that is cause for concern. As you can see up here as well, range 1, 2, 3, 4, 5, 6. Where's it going to end? So once they start, it's a similar concept. When is it going to end? Yeah. So that's the whole don't catch a falling knife expression. We have now just zoomed in on the 4-hour chart, Bitcoin 4-hour chart. So if we start drawing some parallel channels and we grab it and bring it across some candle tops, some candle closes, and then drag it down, this is where we can start playing with the channels in the sense where we begin to speculate. So for example, a speculation, another speculation, another speculation, another speculation. You see these parallel channels are open to interpretation and speculation and bias and all that sort of stuff. If you bring this down, then there's plenty more room for it to run in this shorter, smaller, thinner channel. That's completely up to you then. Then we've still got quite some move downwards still within this channel before we reach the bottom of the potential channel. The channels are open to bias. If you're not interested in channels, then just stick to the horizontals. Horizontals are much harder to fudge. Basically, look, see these candle closes down the bottom here? This is a very important region. Simple as that. If that's broken, then that is a lower low. Super simple stuff. If we bring these indicators up on the 4-hour chart, we'll see that there is no bullish divergence as of yet. So not a good case for the bulls. The stochastics are starting to point up, starting to be erect, and crossing the moving average, but barely. If we zoom back out to the daily chart, then we'll see that the stochastic momentum is up. And it is erect still, so that is a little bit of a hope for the bulls, a case for the bulls. If we flick over to the Kingfisher liquidity maps, we can see, flipping over to FTX, because I find that to be the most accurate. Obviously, FTX and Binance doing the most volume. Binance does the most volume, so I usually check Binance, but I'm a lot more suspicious on FTX, if anything, these days. So the clusters for short liquidations are all sitting on all leverage, on average, at around the 21k mark. For sure. So we could see that there, and on Binance as well. Binance showing huge clusters in the 21k area also. So that's interesting and important there. Some sharp and hard price action moving up to the 21k area would liquidate a lot of positions. Something not so bullish for Bitcoin and most tradable assets is the dollar. So the DXY the US dollar currency index, you can see that it is charging up and trying to make new highs. One thing that works for the case of the assets, if you are on the bull case and hoping for a bounce here, is the fact that the DXY is putting in 3 counts of, well, it's looking to put in its 3rd count of bearish divergence if it does go up and make these highs. So 1, 2, 3, potentially a 3rd higher high on the price action, following this steep-ish trend line. Well, for the dollar it is anyway. And then a 1, 2, and then potentially 3rd count. Most likely will fall short. As you can see, the RSI is still quite low there, and this may fall short here. It wouldn't take long. It wouldn't be hard for a couple of green candles to poke their head above here, without bringing the RSI higher than that previous point. That'll be 3 cases of bearish divergence, suggesting a trend reversal on the dollar. So the DXY and Bitcoin have proven time and time again to be relatively inversely correlated. One of the best traders on YouTube, Eric Crown, has been calling for a bounce, a mean reversion play on the from the Bollinger Bands and the BBWP indicator that he uses, and I also use because it's very, very good for volatility expansion and contraction. He's been calling for a bounce, and I was in that camp as well. But as time progresses and the signals start to play out, you'll see here that as the BBWP starts to contract and the indicator moves below the moving average, and then also the stochastic is starting to point down again, it's not so good for that sign. So you can see the mean reversion play is that after extremes are reached, so outside of the Bollinger Bands like this, and big red bars on here, it is expected to bounce and find its way back to the mean, just like that, just like it always does. It is inevitable that it will find its way back to the mean, exactly like that, basically. So coming back to the mean there. There was no extremes as such here, but maybe here, it's a good example. Finds its way back to the mean, and as time progresses, the mean is finding the price. Instead of the opposite, the price finding the mean. So this can happen. They will find their way back to each other, as they always do. Two lovers separated by some dirty price action. But as time progresses, it's starting to look worse and worse for that bounce, to be fair. So, and to be realistic, and as more red candles like we talked about as well. That'll do it for me. Signing off. Hope you have a good weekend when it comes, and I'll see you on the next one.